Hi, I'm Greg Weimer. Welcome to Conversations with Confluence, and I'm here with Bill Winkeler, our Chief Investment Officer. So we certainly appreciate the time and hope this message finds you doing well and enjoying the holiday season. What we thought we'd talk about today is just some insight on the markets, what we see going on, what we talk about in the Investment Advisory Committee. And I'll give you a spoiler alert. We're going to talk about four things. Three of them will be good news, one not so good news. But we're going to talk to you about four things, and then we'll give them a peek under the tent about some of the principles that we think are essential in portfolio construction. So again, appreciate the time, and let's get started. The first thing I'd ask you, Bill, is just to talk a little bit about the major shift we see happening in the investment industry, which is really good news from investors from a tax standpoint, to ETFs.
Yeah, so probably one of the bigger changes the last 3 years, particularly within how we've approached managing money, is the growth of ETFs, particularly a subset of ETFs called actively managed ETFs. So if you go back in time, the first ETF came out in 1993, so they've been around a long time. In the United States, there's about $10 trillion of assets in ETFs. But what changed a couple of years ago was the introduction of the what's called the ETF rule. And that essentially allowed actively managed ETFs to be issued more broadly and easier. So at the Investment Advisory Committee at Confluence, one thing we looked at about 3 years ago was these particular vehicles. And the thing that's so interesting about ETFs are they allow you to have diversified, in this case now actively managed investments that have that same kind of professional management oversight and deliver strong long-term outcomes, now with a much less likelihood of paying taxes. So the likelihood of capital gain distributions from the funds is very low probability compared to a mutual fund, which has a higher chance of paying capital gains.
Yeah. So as a practical matter, what we've done, right, and thank you for that background, and you've been instrumental in doing that, which we appreciate. But as a practical matter, for new money, right, it's easier to deploy it. It's easier to use ETF models right now. But this time of the year, there's going to be a lot of cap gains this year. Now, the good news is that means the market's done very, very well, but there's going to be a lot of cap gains. And so what we're doing is we're taking the cap gains in cash, and then we're putting them in ETFs. So we are really using ETFs in a meaningful way. And so in your portfolios, now some of you may say, well, why don't I have them? There's a lot of legacy mutual funds out there. So if you have a major gain in a mutual fund already, you can't just sell it because you'd pay too much in tax. So, but this evolution of the ETF world gives us an awful lot of opportunity to save money on taxes.
Yeah, to add context to that, the last, going back to 2010 and to the last 14 years, call it, about $2.5 trillion has left actively managed mutual funds, and about $600 billion has gone in actively managed ETFs. So it's a big change industry-wide.
Let's jump to the second thing, and I don't know if everyone's aware, but there was a presidential election last year. And it's sort of interesting to watch, and I'll have Bill explain. And when you think about the emotion of an election, it's obvious in hindsight, but sort of like follow the money, follow where the money's going. So do you want to talk a little bit about an election year and how people typically invest money in that time frame?
Yeah, there's some strong trends historically. So if you look the last, call it 30 years, and you look at, 4 years of a presidency, and you look at it broken down by each year. Interestingly, the first year after an election, so 2025 in this case, tends to see the largest amount of inflows into the equity markets. That tends to happen for a couple reasons. One, there was an election, there was a clear mandate where the citizens of the United States chose this, and they have a chance to enact their policies and their legislation. In this case, the Senate and House now and presidency are all Republicans, so that group will have a chance to implement those policies. So historically, you see the largest amount of inflows the year after an election. Interestingly, this year we've seen some of that already, where we had almost $140 billion go into U.S. equity investments in November alone. So certainly there seems to be, to use the term animal spirits, a revival in that, and a lot of money flowing into the U.S. equity market.
That doesn't mean the market's going to go up next year, because other things can happen, right? So there's one variable that gives us a tailwind, and it makes sense. So in the election year, by the way, a lot of money goes into money market accounts, which makes sense because the market doesn't like uncertainty. So you're nervous, you're uncertain, money market, cash, right? And then all of a sudden you have certainty. And by the way, that would have been true Republican or Democrat. At least there's some certainty.
Mm-hmm. Yeah, the market likes certainty. So
Yeah. Okay, let's get to the bad news. So the third thing we were going to talk about, I don't think it's news to anyone that we have a huge issue with our national debt. And when you look at the chart and you think about how it's really going to grow, it's problematic. And I'm concerned that I haven't seen Republicans or Democrats obviously address this, or it wouldn't be so high. But you want to talk a little bit about how we dug into the numbers?
yeah, so the problem with that Greg mentioned about addressing it is if you break down what the government spends in a year, about $5 trillion, which in this case is 75% of the 2024 budget, goes to entitlements, so Medicare, Medicaid, Social Security, defense spending, and interest payments on our debt, which we have quite a lot of right now. Over $30 trillion of debt outstanding. So that doesn't leave a ton of wiggle room to cut. And what's happened now is our debt, particularly measured to how much the economy grows in a given year, which is that chart representing debt to GDP. It's quite high. It's the highest it's been ever. So, at some point, politicians will have to get serious, and you're starting to see some signals from the bond market and from investors that they want this to be addressed, in terms of the U.S. fiscal situation.
And you want to talk a little bit about next year and the amount of debt coming.
Yeah, so we have a very tangible amount of debt that needs to be refinanced or rolled over. The last 3 or 4 years, historically, to fund the debt or fund the deficit on an annual basis, the Treasury Department has been issuing short-term Treasury bills. So Treasuries that mature in less than a year, predominantly. We have about the most recent estimate I saw from Bloomberg is about $7 trillion of debt will need to be rolled in 2025. So that's a lot of supply coming into the bond market where investors, will have to consider what kind of interest rate or what kind of compensation they want to purchase the new Treasury debt that has to be rolled.
Yeah. Now the good news is it is certainly a problem. I do have confidence in our country eventually because we're not very good at handling problems. We're actually pretty good at handling crises. So, so once it gets to a crisis, you think hopefully we'll address that, and we're very close now. Let's get to some good news. We believe productivity is going to rise, and we believe that's going to be one of the tailwinds of the market. Not only lower interest rates, lack of less regulation, and productivity increasing. So, do you want to talk a little bit about productivity, and then we can get to one of the how we believe it's going to be turbocharged because of AI.
Yeah, so if you think about what drives the growth of the economy, it's largely how much does your population and labor force grow, and then how productive is your labor force. And more recently, we have not had a lot of productivity growth, and now more recently, even the population growth has slowed down, and that's likely to continue given a lot of potential policies on immigration. So in order to potentially make up for that, it could be the growth of productivity thanks to enhancements from AI and generative AI and the use of those tools. There certainly will be some jobs and workplaces that will need to be retrained, but net so far, at least the previous 8 quarters, we've seen some of the highest productivity growth in the last 20 years, which is a positive sign, particularly as some of our population growth slows down.
And let's talk a little bit about the adoption, right? Because the chart on adoption is amazing. It took us 70 years how to figure out how to flush a toilet, but only a couple years how to use an iPhone. That's amazing. So
we've come a long way from the adoption curve, the adoption curve for toilets. If you look at on the far right-hand side of the chart, the more recent technology adoption rates, we certainly are looking for AI to mirror that of cell phones and tablets, where it's high adoption rate, greater than 75% penetration in very short periods of time. You're seeing it some, I'm sure many of you at the corporate level use Microsoft Office Suite. Their Copilot is a great example of an add-on AI program that's gotten quite popular. So the greater adoption of those AI tools, the sooner we could see a continuation of that productivity growth.
And there will be winners and losers. Like if you have a business or you're not using technology and you're not embracing it and you're not adopting it, you will fall whether it's an ETF or AI, you're going to fall behind quickly. So there's a challenge though, right? You want to talk a little bit, it could slow because as of now, and you can talk about this, we do not have the power grid that will support AI between now and 2030.
Yeah, if you look at a projection of the next couple of years worth of power consumption, the growth of that, the single biggest driver is data centers, which power a lot of the AI tools. And you can Google this. 3 Mile Island here in Pennsylvania, the 2 out of the 3 working reactors. There's data center companies looking to get those restarted because there's such a shortage of electricity to power the AI. So that's a very real, tangible challenge to our infrastructure. It is also impacting the equity markets. Many of the big AI winners of technology companies are the largest companies in the United States, and those top 10 companies now are 36% of the S&P 500. So that's the most concentrated the market's been in over 60 years. So we're seeing it very tangibly from an infrastructure standpoint as well as in financial markets.
Yeah. When he says Google it, the amount of energy it takes to do a Chat GPT search versus a Google search is meaningfully different. Like, you wouldn't think that, but it's meaningfully different. So anyhow, so there's some good news. There's a word of caution. And then I thought it would make sense for us to spend a little bit of time on some principles that we believe are essential in portfolio construction. And it'll give you a peek under tent. These are our principles. These are what we follow. And maybe by going through these, it'll give you some things to think about. So the first one I'll do, and then you could go, is being objective based. I mean, we're objective based. And I want to touch on that because I thought what you just said was fascinating. We believe it's way more important to put together a portfolio that is designed to meet our client's objective. That's one way you could do it. The other way you could do it, that number you just said, people go invest in the S&P 500 thinking they're buying 500 companies that are equal. And just not the case. 10 of them represent, would you say, 36%. So for most people going into retirement or in retirement, they're great companies, but that's an awful lot of concentration and an awful lot of risk. So people are like, are you trying to beat the S&P 500? And some of it's like, shoot, no, we would have to take too much risk with your money, which would be outside of your objective. So we think it's really important to keep your objective as true north.
Yeah. Related to that is our approach in terms of being unbiased. And what that means a couple of different things. That means unbiased in terms of we think we need to select we believe in selecting the most optimal investment, whether it's active or passive, for a particular objective. There are certain cases where some type of passive or passive-like investment makes sense. There are other cases where an actively managed solution makes sense. In addition, the selection of those products, we take a lot of pride in being unbiased. Maybe we want to talk a little bit about anecdotally what happens in the industry, I think.
Yeah, I mean, it's just, there's conflicts of interest, right? So someone from this investment firm will take an advisor golfing, and pretty soon all their clients end up in that. We just don't do any of that. Like, if someone comes into our office for an update, we pay for lunch. Sounds simple, but no quid pro quo, no bias. It's just not going to happen. And being strategic, right? We are strategic. I think with everything happening in the world, doesn't mean we're changing all the time, but with interest rates going up the way they did, we've really moved significant assets to bond funds. So that's also important.
Yep. And then, an important thing is it's not just what you make, but what you keep after tax. So tax efficiency. When you have a taxable investment, it is really important to consider taxes. With the backdrop of where we are from a fiscal standpoint, there's certainly potential in the future at some point taxes could go even higher, but that certainly has a big impact on what drives your after-tax returns. So thinking about actively managed ETFs as well as passively managed ETFs and controlling the tax outcomes is really important.
And trying to, even the funds we have, trying to select ones that are also tax sensitive, right? That they are aware of that in taxable accounts. And then just overall costs. I think it's really important. It's amazing to me how many people aren't focused on the internal costs of mutual funds or ETFs or the spreads or whatever the case may be. So they're principles that we follow. They sound simple. I wish everyone did them. I think we'd have a better investment community. It's not necessarily adopted by everybody, but we just wanted to give you a peek under the tent at the Investment Advisory Committee, what we do and the principles we use to make sure that we take advantage and are aware of what's going on in the world and have portfolios with outcomes that we can be proud of. So thank you for listening to Conversations with Confluence. We certainly appreciate your business. We appreciate your time. If you're a current client and we can help you or any of your friends, please give us a call. If you're a prospective client, we would certainly enjoy you giving us a call to start a conversation. Thank you so much. Enjoy the holidays.